Good day, fellow investors. When it comes to investing, it is very important to think in probabilities and likely outcomes and not fixate on one possible outcome. We've made this video discussing how Google stock can easily go to 500. Great comment here that my title is pure clickbait. You don't seriously believe Google will go to 500 in a few years. Predicting a stock price is not investing, it's just forecasting and rarely serves any value to investors. Stock predictions are just gambling. I watched this whole video too. Thanks for watching the video, but I think the key here is to think in probabilities. Is it possible? What is the likelihood? Can it happen? And then put that into a portfolio. So just a summary here on Google. We have a P ratio of 20, 11% revenue growth, 15% earnings growth, and it is an AI player. If I look at Apple, the P ratio already is 30 for zero growth. If Google continues to grow, if it does well in AI, I would not be surprised that they keep on growing earnings at 10-15% per year, which means earnings per share goes from 9 to 12 in 2 years. AI success, exuberance, P ratio, you are at 480, just like that. That is, I think, possible. I'm not predicting, I'm just putting that into the risk and reward framework for Google. Then that helps me into deciding whether to put Google into my portfolio. This is a free X for Google potential. However, there is also the risk. If AI doesn't work, if there is high capex, if there is cannibalization of its own search revenues, EPS declines to 6, recession, whatever, P ratio 15, then the potential downside is 90. So I have 480, 180 the price, and potential downside 90. What do I think? I think personally that 480 is more likely than 90, even if 90 was not that far ago, and also on the upside. However, the P ratio of 20, which is what is now, gives me a 5% earnings yield plus some growth, likely 5 to 7% long-term from Google, and that is already a 10% long-term return without predictions. And then you put that into, with the predictions, with the risk and reward, into your assessment for the portfolio. Look at as many options as possible. You have a covered list. Here on YouTube, we have a covered list of stocks. We discuss the risk and rewards. Google offers the potential for high returns, but also on the AI competitive landscape there, also there is some risks that we will see whether it will materialize or not. You take these companies, I have a similar quadrant with much better buys on my research platform. Feel free to check that out in the link in the description below. This is in the intrinsic table. There you have the intrinsic values compared to the stock prices. You can see how Apple is extremely expensive. Petrobras is the cheapest here on our publicly shared list, but it is also on the riskier side. However, when it comes to this, why don't we think in portfolio perspectives? Here are stocks that have more than 10% likely returns going forward. They are a little bit risky, volatile, but all have growth, all have upside. So if you put 3% of your portfolio into these and just play on the volatility around, it will do well in your portfolio long term, most likely. And that is investing. When some of these are in exuberant times, 3x, lower your position, you go into something else. And that is the process of investing. And that is why we discuss the potential for the stocks going up and down, but always on that fundamental basis. The fundamental basis here for Google is for a likely 6, 7, 8% conservative expected return going forward. If you are looking for something else, the key is that you find the right fit. Pure value investing would be this, so low volatility, stable, pretty conservative, pretty certain long-term returns, food, low production, oil. However, good investing would still be this. So 10, 12, 7% likely returns in a diversified portfolio. Much better than this, where you know that things are expecting. So we need to train outcome flexibility based on fundamentals, think volatility, to take advantage of what's going on and put the right business at the right time in your portfolio. Google, it goes up and down, so the stock has been at 200, 150, now it's rebounding. I can guarantee you that it will be higher, but it is up to you to see when and how it fits your portfolio, because you might think it doesn't matter 2-3% here and there. It matters. Just the difference in 30 years, 10% returns, 12% and 14% on average per year. These are such small differences, but these small differences compound, and your 1,000 start 17, 29 and 50,000. So you can have 50 times your wealth, 29 times your wealth, or 17 times your wealth. If we go to 5%, then you have just 6-7 times your wealth, or even less. This is why investing matters. And we are not trying to be precise about these predictions or forecasts. We are just trying to put things into a risk and reward perspective. Because as Buffett says, it's better to be approximately right than to be precisely wrong. Thanks for watching. Check my research platform for my best ideas. I'll see you in the next video.